let's start our conversation this hour with the current bull run we're seeing in the stock market. And certainly something that caught our attention this morning was the latest fund manager survey from Bank of America Global Research. And their headline here is certainly one that catches your attention. The only reason to be bearish is that there is no reason to be bearish in this market. We see this chart, one of many from this report, Brian Sozzi, that you flagged for us. Just 13% of investors think that we're in a bubble right now. Interestingly, the largest number of investors, to this, think we're in a late stage bull market rather than an early stage bull market rally. Just an interesting dynamic, considering that we're pretty much lapping the 1 year of those multiple Sunday night limit down chaos breaking out in markets. I would not have believed you if you said in 1 year, don't worry, there'll be zero reasons to be skeptical on the market.
Yeah, and that old adage, Myles and Julie, when people are this bullish, maybe you should get bearish. I mean, that's how I was taught. But really, you can really essentially toss that out in the trash right now. And I have another stat from this report, guys. All-time high in investors taking higher than normal risk, now at 25% in February. Another way to look at it, all-time high in investors taking higher than normal risk. So what does that mean? Investors are going out there, they're buying their Bitcoin, they're buying the Bitcoin derivative trades, they're buying big cap tech, Julie, across the board, which really, it should raise red flags, because you get the sense from this report that investors are not looking at fundamentals and can really care less.
One of the other things that stands out to me here is that, you tend to hear this old saw on the part of some bulls, oh, there's still cash on the sidelines. Although you haven't been hearing it as much lately, and that's because there isn't, at least not according to this. The cash level is down to 3.8%, which they point out at Bank of America, it's the lowest since March of 2013, just before the so-called taper tantrum. And the allocation to stocks and commodities is the high since February of 2011. So people are fully invested here, which also means that, that can also mean that if things do start to go down, it creates this sort of self-reinforcing mechanism, because if all of your money is in stocks and things start to go down, then you have to sell maybe to liquidate some of your positions, or at least lighten some of your positions. And so then it sort of feeds on itself. I mean, all of this said, one of the other, I guess, old saws that we've been hearing from some investors is that these things alone are not the reason why stocks go down, right? You tend to have some kind of catalyst event, even if in some cases it's an excuse as a catalyst event. And this time around, at least, it's not, it's definitely not a taper tantrum, but it's not the bond yields are going up. I mean, we've definitely had some folks come on the show and say, once bond yields start to move up, once there starts to be some inflation risk, that's going to hit stocks. That's not happening now, perhaps because those yields moving up are not necessarily a reflection of inflation risk, but rather a reflection of economic optimism, sort of mitigating any kind of inflation risk. I don't know, guys. It's the bottom line. But the point is, stocks keep going up.
Yeah, and I think it is. I think it is quite challenging to sort of talk about the markets in this phase where, look, I think people make way too much of sentiment. I mean, I know people probably don't like to hear it. It's like, I think discussing sentiment a lot and like that being your whole angle is kind of just a way to make you sound smarter than everybody, right? It necessarily holds you out from the crowd. But Julie, the dynamic that you're outlining, which shouldn't be a surprise to us in 2021, a year where everyone is plugged in all the time to everything, there's just not a lot out there that people haven't talked about or considered. I understand, people forget, in the tech bubble, you had to, it wasn't, the dark ages, but you still were getting faxed earnings reports from companies. It wasn't things didn't work quite the same way where number hits the tape, everyone on Twitter sees it, everyone knows what's happening, anyone can pull up a free transcript of an earnings call and know kind of anything about anything. It was just a little bit more informationally arbitrageable. In this market, that doesn't really exist to the same degree. And I think worrying too much and spending too much time saying this is overheated or that is overheated can end up being this intellectual exercise that doesn't necessarily generate any returns. And, the folks that I think have been most interesting, and they've obviously been right, are people who say, look, the trend is up. So, you're free to fight that if you would like. But last time I checked, more stocks making more highs tends to be bullish for the market, not bearish. And I don't know. It's kind of like this. Let's do the simplest thing that we can do to talk about markets these days, because everything is overly complex, it seems, in this world. So, I don't really know how this all resolves, but certainly it does feel like this is the dynamic that we have now. This is the market, as it were, and certainly one that we're going to be following for some time.